Hello, everyone. Welcome to a weekly update on the financial market. My name is Tim. US stock climbed on Friday, wrapping up a strong week on Wall Street as investors hoped a disappointing January job report would increase the likelihood of further stimulus. The Dow Jones Industrial Average rose 92 points or 0.3%, led by Nike and Cisco. The SP 500 climbed 0.4% to record close of 3,886 as 10 of the 11 sectors posted gains. The Nasdaq Composite advanced 0.6% to 13,856, also hitting a fresh closing high. All three major benchmarks notched their best week since November. The blue chip Dow gained 3.9% for the week, while the SP 500 and the tech-heavy Nasdaq jumped 4.7% and 6% respectively. The small-cap Russell 2000 rallied 7.7% for its best weekly performance since June. The Labor Department said U.S. added 49,000 jobs in January, slightly below the 50,000 payrolls expected by the economists. The unemployment rate fell to 6.3%, better than projection of 6.7%. December's numbers were revised much lower, with the month posting a loss of 227,000 from the initial reading of 140,000 job lost. The Senate passed a budget resolution early Friday as Democrats moved forward with the process to pass a 1.9 trillion coronavirus relief bill without Republican votes. The package includes 1,400 stimulus checks, a supplemental jobless benefit, and COVID-19 vaccine and testing funds. Wall Street was also in the middle of a solid earnings season. Of the 184 companies in the SP 500 that have reported earnings to the date, 84% topped analyst expectations, according to the report. The rally's three pillar actually got stronger. Q4 earnings continue to dramatically exceed expectations. More stimulus is being poured into the economy, and the vaccination pace is accelerating. According to the famous Buffett indicator, the global market cap versus global GDP ratio has been at all-time high of 122%, higher than the previous high of 2007 prior to the 2008 crisis. A look at the 10 most purchased stocks by retail investors during the market mania last month is missing one key stock, GameStop. AMC Entertainment and Plug Power, two names caught up in the trading frenzy along with GameStop, were popular buys among retail investors. However, JP Morgan found the brick and mortar video game retailer that seemingly put Wall Street on his heels is notably absent from the list. The prevailing narrative was that a band of Reddit-inspired small traders rose up against Wall Street by buying GameStop, forcing a short squeeze by professional hedge fund managers who were forced to cover their negative bets or risk catastrophic losses. But several signs were pointing to institutional investors as big drivers of the wealth price action on the way up. As big drivers, including those institutional investors, although retail buying was portrayed as the main driver of the extreme price rally experienced by some stocks, the actual picture may be much more nuanced. JP Morgan's quant team used public data from exchanges and applies a proprietary methodology to identify which flows are from retail investors. GameStop was number 15 on the firm's retail buying list for January. Data shows institutional investors as driver of large portion of the wealth price action in GameStop last week. University of Chicago law professor Todd Henderson, whose research specialized in corporation security regulation and law, and economist, think hedge funds were the driving force of GameStop rise is largely flawed. He said, I know people are hauling up on Reddit and the little guy sort of teaming up on the big guys. I think it was just the big guys teaming up on the big guys. While the GameStop bubble is popping this week, with the shares down more than 80%, regulators in Washington are not forgetting about last week's drama. Both House of Congress are planning to hold hearings regarding the GameStop mania, and newly appointed Treasury Secretary Janet Yellen said she will be meeting with the heads of the Securities and Exchange Commission, the Federal Reserve Board, and the New York Fed, and the Commodities Future Trading Commission to discuss whether recent activities are consistent with investor protection and fair and efficient market. Regulators want to get to the bottom of what exactly occurred last week, said Ryan. One response will be for regulators to look into exactly how this occurred and whether there were bad actors with bad intentions mixed in with people that were just looking for information and were taking part in a trade they are enthusiastic about. SEC regulators are reportedly combing through Reddit posts to identify if there were any bad actors trying to manipulate the market last week, according to Bloomberg News. The regulatory agency is also investigating the possibility of bots playing a role in the mob. Matters came to a head early on January 28th when the clearinghouse that handles Robinhood's trades demanded a put up a total of $3 billion to cover the day's trading, a cushion for the risk created by a standing run up in a few stocks, including GameStop and AMC and others. The demand, 10 times Robinhood's daily requirement early that week, set in motion a chain of events that included stopping customers from buying the very stocks that made apps so popular. Yet all the while, big investors were clamoring to get a piece of Robinhood and its explosive growth. The firm's executive, looking to amass capital in little time, dialed up a long list of existing backers and potential new ones. The deal it reached with some of them was a note convertible into equity at a discount to a future's initial public offering price. It ultimately cut us off at $3.4 billion raised. The next few months will test Robinhood's like no other time since it's planning to go for public. To do so, Robinhood have to clear the high growth bar set by Wall Street investors while simultaneously repairing Robinhood's ties with the retail traders who made it go viral. That's all for today. If you like the content, please subscribe to the channel. Stay tuned. I'll see you next time.